AI is real. AI demand is real. But that does not automatically mean every AI stock is a good investment at every price. This week, the market gave investors a sharp reminder. On August 18th, the Nasdaq fell about 1.3% and the S&P 500 fell about 0.7%. Nvidia fell about 2.3%, Micron fell about 7%, and Broadcom fell about 3.2%. The backdrop was a jump in long-term bond yields. The 30-year Treasury yield touched about 5.33%, its highest level since 2007, according to market coverage. On August 19th, stocks stabilized, with the S&P 500 closing at 7,707.98 and the Nasdaq at 26,331.09. So, is the AI boom breaking, or is this a normal reset of expectations? In this video, we will look at both sides and 5 questions to ask before buying an AI-related stock or fund. This is general education, not personalized investment advice. The first connection is the discount rate. An expensive growth stock is valued partly on profits investors expect far into the future. When long-term interest rates rise, those future profits are worth less in today's math. Investors may demand a lower price for the same promise. Higher yields also raise the cost of borrowing. AI companies and cloud providers are spending enormous amounts on data centers, chips, power, cooling, and networking. If more of that build-out is financed with debt, higher borrowing costs can pressure future returns. That is why the recent market story was not simply good AI versus bad AI. It was also about the price of money. The bull case starts with real demand. AI infrastructure is being built because companies want more computing capacity. Cloud providers, software companies, chip designers, and data center operators are trying to sell products that customers may use for search, coding, customer service, drug discovery, logistics, and business automation. Some AI leaders are profitable businesses with real revenue, large customer relationships, and strong balance sheets. That is very different from buying a company with no product simply because it uses the word AI in its name. AI can also create value outside the obvious chip names. Software companies may use AI to lower costs or increase revenue. Industrial companies may use it to automate inspections, maintenance, and design. The long-term opportunity may be broader than one group of semiconductor stocks. The bear case is not that AI does nothing. It is that investors may be paying too much for future growth. 5 risks deserve attention. First, valuation. If a stock price assumes years of near-perfect growth, a small disappointment can create a large decline. Second, return on infrastructure spending. Building a data center is not the same as earning an attractive return on that data center. Third, financing. When suppliers, customers, and investors become tightly connected, the market must ask whether revenue growth is independent and durable. Fourth, customer concentration. A company that depends on a few giant cloud customers can look unstoppable until one customer changes its spending plan. Fifth, index concentration. Even if you never buy an AI stock directly, broad U.S. index funds may already have meaningful exposure to the largest technology companies. Question 1. What is the company selling and who is paying? Look for revenue from real customers, not only partnerships, pilot programs, or announcements. Ask whether the product solves a problem customers will keep paying to solve. Question 2. Is cash flow keeping up with the story? Revenue growth matters, but so do operating cash flow, capital spending, debt, and the cost of building the infrastructure. A company can grow quickly while spending even faster. Question 3. What growth is already priced in? A great company can still be a poor investment if the price assumes more success than the business can deliver. Compare valuation with realistic growth, margins, competition, and downside scenarios. Question 4. How sensitive is the company to rates and financing? Rising yields can pressure high-growth valuations and highly leveraged infrastructure companies. Read the balance sheet and debt maturity schedule instead of looking only at the stock chart. Question 5. How much of your own portfolio is already exposed? Check your 401k, IRA, brokerage account, and sector funds. You may own the same AI leaders through several different funds. Add direct positions only after you understand the total exposure.
You do not need to predict whether AI will change the economy to build a sensible portfolio. Start with time horizon and risk. Money needed soon should not depend on a single volatile stock. Use diversification. A broad index fund can still contain technology exposure, but it may reduce single company risk compared with owning one AI stock. Use position limits. If one position grows into an uncomfortable share of your portfolio, rebalancing can reduce risk without requiring a perfect market call. Consider dollar cost averaging instead of putting a large amount into a fast-moving theme on one headline. Avoid leverage and options unless you fully understand how quickly losses can compound. And separate the technology thesis from the stock thesis. You can believe AI will be important and still decide that a particular price is too high for your risk tolerance. Watch earnings quality, not just earnings headlines. Watch whether cloud customers explain how AI spending becomes revenue or productivity. Watch capital expenditure, debt issuance, free cash flow, and customer concentration. Watch long-term Treasury yields because they influence the discount rate applied to future growth. And watch whether market leadership broadens beyond a small group of mega-cap technology names. The best evidence will not be a viral prediction. It will be repeatable revenue, cash flow, customer demand, and reasonable prices. The AI boom may continue. It may also produce corrections, failed projects, and companies that spend too much before earning enough. The right question is not, is AI good or bad? The better question is, what am I paying, what could go wrong, and how much exposure can I afford? Do not chase a theme because everyone is talking about it. Do not reject a technology because 1 week was painful. Build a diversified plan, size positions carefully, and let evidence, not excitement, drive the decision. Subscribe for data-driven U.S. finance videos. Comment AI if you want an AI stock checklist next. This video is general education, not individualized investment, tax, legal, or financial advice.